You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
I'd very much like to welcome you to one of a series we have on the Friedman Forums to acquaint undergraduates with some of the most interesting research topics of the day. Before I introduce our speaker, though, as many of you have already heard, over the weekend we learned of the death of Gary Becker, the namesake of this institution. He was a brilliant and creative scholar whose work was remarkable for its breadth and impact. To me, he's has been the face of Chicago economics for decades now. And what he really did in a very important and central way is expand the scope of economic analysis to address just a whole wide variety of social problems of considerable importance. Just open up new fields of endeavor like family economics, and enhance the field of human capital, and just a variety of just really important contributions. If you think about Gary's contributions in terms of influencing students, one could count, the number of BAs, papers that he might have advised, or events like that. But that kind of misses the boat. Gary would talk to anybody who had a serious interest in learning about economics, and I kind of witnessed this having an office right next to his. And if you look at the number of students that he's influenced, he for a long time taught a very unique special course in price theory that just convinced a whole generation of economists how to use those tools to address important questions. And so, those people have gone out to influence students, and so it's just his influence on economics has been truly remarkable, and it's just hard to overstate it. But let me now turn to today's speaker. Our speaker is Maurice Obstfeld, whom I've been lucky enough to know for many decades now. He is a leader, one of the leaders in the field of international economics and macroeconomics and international finance, and kind of connections between all three. He's done just fundamental research in these areas that have really changed the field, and enhance our insights. I'm very much looking forward to his insights today. I think we should all feel very privileged that he's here visiting from Berkeley as just a truly top scholar. Maury?
It's a real pleasure to be here at Chicago, where so much of modern economics was invented, and a significant fraction of that is due to Gary Becker, but also many other people, including Lars, who I first started learning from as soon as I finished my PhD, and went out and met other economists. So it's really great fun to be here. I'm going to talk about financial globalization and financial crises. And this is obviously a topic that everyone is interested in after the global financial crisis of 2007-09, the worst global financial crisis since the Great Depression. Its effects are still with us. Industrial countries still suffer from high unemployment. In some of them, GDP has not yet reached pre-crisis levels. And this global crisis, if it weren't enough, was followed very quickly by the Eurozone sovereign debt crisis, which, despite the fact that Ireland and now just recently Portugal have returned to private borrowing markets, is not resolved at all, and is pretty much in remission, in my view, but could come back. And I'll try to say a little bit more about that at the end. I also will welcome questions about the Euro crisis or anything else. Recently, there have been concerns about emerging markets, starting last spring, in the fall, when the Fed began to make clear that it was thinking about reducing its recent years of monetary accommodation. We saw various tremors in the emerging markets, capital outflows and currency depreciation. So all over the world, we see events that potentially cause questions about financial stability. Well, there are four questions I want to focus on today. while trying to keep within the time limits. What is a financial crisis? Why do they matter? Is the recent experience very unusual in the broad sweep of history? Is there a special role for financial globalization in the process? Most of the discussion in the US around the global financial crisis didn't heavily emphasize the global aspects, but for those of us who sort of work in the field of international, those loomed very large. So I want to bring those into the discussion. And finally, should we do anything to reduce financial crisis risk? Can we do anything to reduce financial crisis risk? What are the key takeaways on that important set of policy questions? Well, first of all, what is a financial crisis? It's hard to define it unambiguously in a way that will make everybody happy, partly because they can originate in diverse parts of the financial system, as I'll discuss, and they can also be a matter of degree. What we mostly fear are what economists call systemic crises, really large-scale crises that call into question the stability of the entire system. If I have a student loan and I default on it, that's not a crisis. I mean, it might be a crisis for me, but it's not a crisis for the economy. On the other hand, if 40% of students default on their loans, that starts to be a crisis because the lenders who have lent to them get into trouble, and therefore so do the lenders that have lent to them potentially. So I'll just give a tentative definition just so we have something to work with. I'm not prepared to go to the stake for this, but let's just say that a financial crisis is a situation in which a significant fraction of private actors, who can be households, firms, or banks, or even some public actors, who can be local governments or the national government, fail to uphold financial commitments with disruptive effects on the general economy. If you look at 2007-09, the global financial crisis, it started when households a little bit earlier started defaulting on mortgages, calling into question the solvency of the holders of these mortgages, who, as it turned out, were scattered worldwide, which is where the international aspect comes in. Well, one very basic point to make about big systemic crises is that they are associated with declines in aggregate output. And just for the past 22 years, I list some of the broader crises that have occurred. And you can see pretty clearly that in various regions of the world, you see effects. Sometimes these are direct, sometimes these are spillovers. And I should mention for interpreting this that because I was lazy, my graph of all advanced economies here also includes the Eurozone, which I show separately, along with the emerging and developing countries. I know the slides will be posted. I urge you to peruse this later. But what I run through here is the European monetary system crisis in the early 90s, which you may not remember. Don't have time to really describe it. But it was centered around the origins of the euro 7 years later. The Asian crisis, big effect on emerging markets. The dot-com crash in the early 2000s, very clearly in evidence. The global crisis is, absolutely huge in its effects, very obvious. And then the euro crisis, which, like many crises, we see most clearly its effects in the euro area, but arguably there are spillovers to the developing world as well, which become greater over this period as countries become more highly linked, not only by trade, but importantly, in view of my theme, financial markets. Okay, so I listed on that chart a bunch of crises, and in fact, they're all very different sorts of crises with very different effects. The recent crisis was marked by a lot of banking distress, and so banking crises are one prominent form of crisis. Banks have short-term liabilities, but tend to hold longer-term assets or more illiquid assets. They provide liquidity to depositors and other short-term creditors. But if all of those depositors or creditors demand repayment at once, the bank is going to have a lot of trouble meeting those obligations. And when this happens on a large scale, banking crises arise. Governments sometimes default on their debt obligations. Most recently, we saw a very well-publicized default by Greece in the Eurozone, but other countries default all the time, particularly in the developing and emerging world. And of course, even in the US, we've had a lot of discussion of default surrounding the extension of the US debt limit. So default is an important category of crisis. And another one that is less familiar for people who only look domestically is the currency crisis. Countries sometimes fix exchange rates because they want the exchange rate not to be bouncing around for various reasons. And in this sort of situation, a government can come under pressure when markets doubt its commitment, because by fixing the exchange rate, the government is providing basically a one-way bet to markets who think the exchange rate will move in the other direction. In fact, these are the three main crisis categories that have been studied. But you can also think of these major areas as transmission mechanisms for other crises or amplification mechanisms. Problems can arise with mortgages, as in the recent US experience, with sovereign debt, and then get propagated through other markets. If we go back to this graph, the EMS crisis was a currency crisis. The Asian crisis involved elements of, currency, banking, sovereign debt. The dot-com crash is kind of interesting because it wiped out holders of overpriced equities, but because they weren't highly levered, it didn't really propagate to banks in the United States. However, in some emerging markets, it was associated with a lot of corporate defaults, which put some pressure on banks. The global crisis was basically banking, not much in the way of currencies. And the euro crisis sort of has everything. It has sovereign debt, it has banks, and even currencies, in the sense that markets began to doubt whether countries that were in the Eurozone would be able to stay within the Eurozone and might not have to exit and adopt new currencies. Okay, there are two themes I want to talk about to just put crises in context of how economists like to think about them. And the two crises, the two concepts are interconnection and expectations. So when you want to think about the vulnerability of an economy to a crisis, first thing you want to think about is how interconnected are financial markets, because there can be important domino effects. As in the example I gave of student loans, if I don't repay my debts, anyone who's relying on my cash to come in so that they can repay their debts may themselves be forced to default, triggering a whole cascade of defaults in the system. And this is the kind of systemic effect that central bankers and finance ministers fear. The problems are especially severe when there's a lot of complexity, a lot of interconnection among institutions. And one of the issues that economists have turned to studying recently is networks, financial networks. How interconnected are financial institutions, and how can you use those interconnections to measure vulnerability? It's likely to be a big research area going forward. But banking crises are not events that happen in a vacuum anymore, in the sense that governments feel a responsibility to step in and do something. In 1907, the US had a major crisis. The US had no central bank, And it was really private institutions led by J.P. Morgan, the man, J.P. Morgan himself, who sort of stepped in to save the situation. This actually led pretty directly to the founding of the Fed. But nowadays, the government is going to step in with all sorts of monetary and fiscal tools when a banking crisis arises. The problem is that the government's interventions can put the government itself into a precarious financial situation. And in the Euro crisis, we saw this in a number of countries. Spanish banks get into trouble. The Spanish government incurs debts in supporting them. Suddenly, Spanish government has a really high debt to GDP ratio. Ireland's case is even more dramatic. They entered the global crisis with a debt to GDP ratio of around 20%. They come out at the time of the Euro crisis with a debt to GDP ratio of 1. And it's because they've been supporting banks by issuing government debt. Of course, when all of these network effects are being realized in a systemic crisis, there's a lot of imperfect information. Nobody knows what's on the balance sheet of the key actors or who is exposed to their potential defaults. And so that causes what economists call contagion. Of course, doctors also have a concept of contagion, and it's very similar. So the second key issue is expectations. How do you think about expectations evolving during crises? Are there ways policy can manage expectations? Well, to some degree, there's clearly a psychological element in crises. People talk about panic. People talk about fear. People have done research on, sweaty palms during crises. This is certainly there. But even if we take a purely rational perspective, there is the possibility of multiple equilibria setting off crises. What do I mean by multiple equilibria? Well, again, think of the case of a bank. The bank has illiquid assets. It has very liquid liabilities. Usually the bank relies on a steady inflow and outflow of deposits so that it never has to pay off too many depositors at once. And that works just fine, and the bank makes profits. But suppose there's some bad news about the bank. It may not even be such terrible news, but markets get the idea, depositors get the idea that the bank is weak, that maybe it is insolvent, maybe its assets can't cover its liabilities. Well, then those depositors may all line up and ask for repayment. And if that happens all at once, the bank is going to fail. Now, there are very many mechanisms that have been put into place to try to deal with this problem. The most effective has been deposit insurance, which was put in place in the US after the events at the beginning of the Great Depression when many banks failed. But banks increasingly rely on wholesale lenders, large lenders who are not protected under the umbrella of deposit insurance. Those people can also causing a run on the bank. And so this is something we saw in great abundance during the global financial crisis. Sovereign debt can have similar dynamics. If everyone in the marketplace decides that Italy, say, is insolvent, then they'll charge it higher interest rates, and it may indeed become unable to pay its bills. On the other hand, Italy with a debt to GDP ratio of 100%, and paying interest rates of 3% on that debt is, basically got to fork over 3% of GDP a year. And that's actually a manageable fiscal problem, provided that you can, actually collect taxes, which is not so easy in Italy and even harder in some other European countries. But, in principle, you can see how if with that GDP ratio, markets are suddenly saying, well, no, we need 10% because you may default, you have a real problem. Okay, so many varieties of crises, and they interact. and that can make them even more systemic. Now, crises have been around for a long time. They didn't start in 2007. They didn't start in 1992. And I have one example here. It turns out you can go way back thousands of years, but one of the earliest sovereign debt crises involved an actual sovereign, Edward III, who had the idea of invading France to regain lands that he believed rightfully belonged to him. Except he didn't have the money to do this because Britain was somewhat advanced in its sense that the sovereign couldn't just tax people in an unlimited way. They had the Magna Carta, et cetera, et cetera. So Edward hit on the idea of borrowing from Italian bankers, the idea being that once he had regained all these rich lands in France, he would repay them. Well, his invasion did not go well, and he ended up defaulting, which bankrupted the Italian lenders and set off a credit crisis in the Mediterranean. So, early example. US states defaulted on foreign debt early in the 19th century. A big global crisis in 1890, the Bearing Crisis, began with loans to Argentina, mostly by England. The US panic of 1907, I already mentioned. 1929 crash, that's one you're all familiar with. The entire globe operated under a system of fixed exchange rates up until the early 1970s, when they collapsed in a series of very dramatic speculative attacks. 1980s were dominated by a debt crisis in developing countries, which led to a decade of lost growth in Latin America. And there are lots of near misses also. If you follow this stuff, long-term capital, 1998, that was a near miss. And even the developing country debt crisis of the 1980s could have been a much larger crisis because many US banks had lent heavily to countries that were in danger of default. And had they defaulted, it could have wiped out the equity of these banks. Okay, so some very rough numbers, just to give you an idea of magnitudes. Pierre Gurenschas and I did a recent tabulation, and here we went from 73 to 06 only, and tabulated 127 currency crises, 62 banking crises, 74 default crises in 79 countries. The definitions of these are open to discussion, but I think the order of magnitudes are pretty accurate. And of course, after 2006, and only up until 2010, so not including the Eurozone events, we saw a further 6 external default episodes, 9 currency crises, and 21 banking crises. And those were mostly in advanced countries. In fact, it's very striking to look at the incidence, frequency of ongoing banking crises since 1970. And these are some data that were put together at the IMF. The red portions of the bars are advanced country banking crises. And what you see very clearly here is that, the global crisis was really a huge banking crisis, in the advanced countries, in these countries where, we sort of thought, we here have figured out how to do financial regulation. We here have, very strong institutions. These emerging markets have poor governance, and that's why they have so many banking crises. And of course, there had been, events in the advanced countries, in the richer countries, but, they're comparatively rare. But then, we come here and, advanced country banks are, sort of going down in droves. Now here we're also including the Euro crisis, by the way, but the Euro crisis is pretty much driven by a lot of the same elements that drove the global financial crisis. So not surprising that it continues. Okay, well, if crises have been around for a long time, and if now they have moved big time to the richer countries, it raises the question, have they changed in some way? Is there some reason for this? And actually, if you sort of look at the precursors of crises and their aftermaths, statistically, one of the striking things is that qualitatively, at least, they're very similar for advanced countries and emerging market countries. The causes and the effects seem to not be that different. There can be quantitative differences, and each crisis is a specific event. You can find some broad regularities, but they kind of play out in their own ways, like Tolstoy's Unhappy Families. Often crises come as twins, banking and currency, or banking and sovereign debt, or even as triplets, all three. And certainly that's been true in the euro area, where, to my mind, the first act was banking crises. But two robust predictors are rapid growth of credit in the economy, of bank credit, and a rise in what international economists call the real exchange rate, which is basically the competitiveness of your economy compared to other economies. And just to give you an idea of, what the domestic credit data would look like for the euro crisis, here they are, domestic credit as a ratio of GDP. And, it's pretty dramatic, particularly in, Portugal, Spain, and Ireland. Though if you look at Germany, domestic credit since the start of the euro, which was January 1999, is pretty much flat leading up to the crisis. Greece down here, big increase in domestic credit. So this idea that, if there's a lot of lending going on, and if it's growing very rapidly, that we should worry maybe, because maybe banks are moving along the extensive margin of quality. I think that's seems to be very powerfully there in the data. Now, I saw in the elevator that in a couple of weeks, Paul Tucker is going to be here at a booth talking about the money and credit. He was the head for financial stability at the Bank of England. So I'm sorry I'm going to miss that, but if any of you guys are interested in that talk, you should really go listen to him, because he's a marvelous speaker. Okay, so this brings us to financial globalization and the role that it may play in crises. And financial globalization at some level is a two-edged sword. It's a form of trade between countries, and we know from very basic economics that there can be gains from trade. And similarly, there are very important theoretical benefits of globalized finance that are quite analogous to the gains from international trade of textiles for wine or commodities. There are two main categories of financial trade. Trade over time. A country with needs beyond its income may borrow from countries that have needs that are less than their income and pay back later. But also we see countries trading across, what we call in the jargon, uncertain states of nature. Okay, so basically we don't know what event is going to happen in the future, but we want to hedge our risks against those events. So, I'm going to sell you a security that, pays me if I have a bad outcome, and, you're going to sell me a security under which I'll pay you if you have a bad outcome. One very simple way of thinking about diversification is in terms of equity markets. Your country has a stock market, my country has a stock market. If we each swap shares so that I'm now holding half of my shares and half of your shares and you're doing the same, then we've diversified. We've, managed to find an allocation that we both prefer because our risks are lower. So, diversification, insurance is a form of trade against states of nature. I'm going to pay the insurance company in states where my house does not burn down, but then when my house burns down, they will pay me. So this is, obviously really important. But the shortcoming of this sort of trade is that we can't be sure that when the time comes for contractual payments to be made, they actually will be made, right? So I lend to Greece, they sell me a bond, they're supposed to pay me back. What happens if they default? Or, I've made a contract with a bank that they're going to, cover my foreign exchange risk by buying a currency that I have on a future date and, selling me a currency that I need on a future date. What if that bank is actually going bankrupt on that date? How do I protect myself against that? So, financial markets, again, there is this risk of default, and that makes them less straightforward in a way than the conventional markets in which we look at the gains from trade. How can we measure financial trade? Well, a standard measure we use to measure trade over time is the current account balance. And the definition of the current account balance is a country's income less its expenditure. It's an accounting identity because the balance of payments has to balance, okay? If I'm spending more than my income, I have to be settling that by selling some assets, by borrowing effectively. So the current account balance is also the net amount lent abroad, or the balance of financial flows, or the net purchase of foreign assets. So this is one measure of financial trade, of trade over time. And if we look at the data, it's quite striking what happened after, let's say, the early 90s, the mid-1990s, which is the sheer size in dollar terms of current account imbalances rose in a way that had not been seen ever before in the post-war years. I broke out here developed countries, and that's mostly the US deficit you see down there, developing countries that are oil exporters and developing countries that are not oil exporters. So China's in the latter category, Saudi Arabia is in the former category. And a huge deficit opened up for the advanced countries, balanced pretty much by surplus for developing countries in general. And for the US, the deficit reached something like 700 billion, or about 6% of US GDP. Well, this is one measure you can look at, and you can say, well, that was a big change leading up to the global crisis. Do we think that's a problem? But there's an even bigger change out there in the international data on external debts and assets, which is not these flows of lending, but the actual gross positions. So let me sort of put it this way. Suppose I'm a country that's running a current account deficit, and I need to borrow $1 from foreigners. One way I can do that is to sell foreigners a $1 bond, which commits me to pay them back, $1 with interest at some point in the future. But there are unlimited other ways of financing this same flow. For example, I could borrow $2 and lend them $1, or I could borrow $100 and lend them $99. And any of these transactions still has a net borrowing by me of $1. But there are very big gross transactions that go in the other direction. And if you look at the data, the level of these gross transactions has been growing. and have led to gross asset positions that are very large relative to countries' outputs. So basically, countries have, very large foreign assets, very large foreign debts. The difference between those is the net foreign debt, or the net foreign assets, the rate of change of which is related to the current account. But these gross positions are really, really big. And you can get some idea from these data where I've graphed gross positions of high income and emerging countries as measured as the average of foreign assets and liabilities divided by GDP. And for the high income countries, you can see these numbers getting very big, and they're certainly growing for the emerging countries too. Now, these figures conceal a lot of heterogeneity. If you look at a country like Switzerland, its foreign assets and liabilities are, on the order of 8-9% times GDP, not percent, times GDP. For the US, we're looking at numbers like, 1.4, 1.3, which are big. US GDP is a big number. So there are all these gross positions out there. And, one needs to ask how we explain these. And I'm going to skip a graph because we're running out of time. How do we think about these? It's hard to think about them in terms of diversification of equity markets, because if that were the case, then the U.S. would basically sell off like 3/4 of its stock market to the rest of the world and buy the global portfolio of equities. And so we would have a external debt or external liability to GDP ratio of 0.75, and instead it's twice that high. And if we look at tiny countries like Switzerland, Netherlands, the UK, when I say tiny, I mean, they're not really tiny, but they're tiny relative to their external portfolios. You have to ask what's going on. Now the problem is that many of these assets, most of these assets, are debt-like instruments which involve counterparty risks, the risk of default. And it's hard to know what's driving this proliferation of gross positions. Some of it is totally harmless. It's just like, it so happens, for example, that a lot of mutual funds are located in Ireland for tax reasons or whatever, and money comes in, and that swells the liabilities of the Irish state, and money goes out as the funds are invested abroad, and that swells the assets. And it's really not a big deal because it really has nothing to do with the Irish economy. But in other cases, there's less of a benign interpretation, or there's a financial stability risk. So there was a very big trade in the 2000s, late 2000s, where U.S. money mutual funds lent to European banks who invested in U.S. subprime assets. And this ended up leading for problems both for the money market funds and for the European banks. If I put my money in the Cayman Islands and a Cayman Island bank relends it, is that something that's socially beneficial, or, am I just, exploiting a desire for secrecy that I can get in the Cayman Islands? There may be things that are positively not beneficial, tax evasion or tax avoidance. Think about a Russian oligarch whose money round trips through Cyprus because investments in Russia from Cyprus can qualify as tax-preferred FDI. There's a lot of this round tripping going on, and we just don't know if it's helpful, is it harmful, and what are the implications for financial stability. Well, at the national level, we've adopted three basic approaches to safeguarding financial stability. one is deposit insurance that I mentioned. Another is the lender of last resort. The central bank, which is allowed to print money, can always lend to a bank that is facing a depositor run, which is not justified by any fundamentals. And the doctrine of the lender of last resort has been around for quite a long time. And most central banks play this role. The Fed did it large scale, obviously, in the global crisis, the ECB in the Eurozone crisis. And a third sort of prong of this approach is that, we regulate, supervise, and resolve insolvent banks as a way of ensuring financial stability. And of course, these three things are very much, interconnected. If there's deposit insurance and if there's a lender of last resort, financial institutions and depositors may take bigger risks. This is what we call moral hazard. And so regulation is meant to try to deal with those risks, make sure that moral hazard doesn't undermine the system and create huge costs for taxpayers. Okay, so keep these three approaches in mind when we ask about the global context. In the global context, the three approaches become problematic in various ways. Now, the discussions can get pretty technical pretty quickly, but just to list a few of the issues that arise, one is regulatory arbitrage. If we have open capital markets, banks and others can shift activities to lightly regulated venues. And this compounds financial fragility. It undermines what national regulators are trying to do. It's also true these days that banks trade in multiple currencies. So if you're a French bank, you're likely to have a lot of liabilities in dollars and a lot of assets in dollars. And we might say, well, that's okay, the bank is hedged, but it's actually in a precarious situation, even if it's not explicitly facing currency risk, because it's likely to be the case that its dollar liabilities are short-term and its dollar assets are less liquid. And so this bank, this French bank, hypothetical French bank, still needs the lender of last resort. But wait, the European Central Bank can't print those dollars that the French bank might need. So what happens then? In the open economy, banks can become really, really big. All you have to do is borrow and lend, and you have a big balance sheet. But when banks become very big compared to the sizes of their national economies, it becomes harder for the government to credibly backstop them in the various ways that governments do backstop the banking system. In Spain, Banco Santander has a balance sheet that's bigger than all of Spain's GDP. Spain is fiscally challenged at the moment. So what do markets think about Santander's, credibility in paying its debts? It's a huge problem in the Eurozone now because, in a supposedly integrated financial market, lenders identify financial institutions by nationality and look to the financial health of their governments who are their protectors, and it leads to segmentation of markets. Another issue is to resolve or to wind down big, complex global banks. One of the biggest problems in the global financial system, to my mind, not just in the US, is the problem of too big to fail. Banks need to be able to fail, and for them to be able to fail in an orderly way, you need a whole body of regulations and procedures and need to know a lot about them. But when banks are global and complex, there are a lot of pieces, and what one government does to wind down the bank is going to have implications for foreign countries. So to actually credibly resolve these banks, you need international agreements. So, too big to fail on the global stage is much worse than it is even domestically. So, at the global level, the problem of financial instability is really quite a big one. And a couple of the examples I've given, hopefully indicate that, I believe it did play a big role in the, certainly if not in the genesis, but certainly in the propagation of the global financial crisis. Okay, so, where does one go with this? What have policymakers been doing, and how effective has it been? What are the challenges? Well, if one thinks about financial stability in a global context, then there are obviously two broad categories of measures that you can think about. The first is measures that countries can take by themselves, and the second is measures that need international cooperation. And either of these approaches is problematic, but for different reasons. In the first case, if you're a government that is contemplating unilateral action, you first have to ask about effectiveness, because, it may be that with other governments not doing the same thing, it's just going to undermine what you do. I mean, there's a very similar problem with respect to, regulating CO2 emissions at the global level. If the US and Europe have strict regulations on emissions, that's great, but, what about the rest of the world that isn't doing that? So it's not very effective. It's similar with financial institutions. You can have financial pollution, and if you just have a couple of financial centers that are taking strong actions, a lot of financial activity will move elsewhere, but it'll still affect you when a crisis comes. But in addition to that, when I take some action, I may have adverse effects on my neighbors, so they're going to care about what I do. The second approach, which is international cooperation, is that it's really hard to create and police international agreements. We have, a wonderful example of progress in this area in the World Trade Organization, but once you get to the financial sphere, it becomes much harder to police, enforce, and agree on what to do. Okay, well, there are things that countries can do, emerging countries as well as advanced countries. Don't fix your country's exchange rate. It's one of my favorites. That generally comes to tears. Very few examples of countries that have been successfully able to do this over long time periods. Try to discourage your financial institutions from denominating debts in foreign currencies. Even if their books are seemingly balanced, they may not be. For example, a bank may borrow dollars and lend the dollars to a domestic corporate, but then if the corporation, invests in non-dollars, it may end up going bust, at which point it can't pay the bank, at which point the bank is stuck with dollar liabilities. So try to control that. Try for better domestic regulation if you can, so Dodd-Frank in the US. For developing countries, they have gone to self-insurance through international reserve holdings, right? If you Korea, say, and your banks have a lot of dollar liabilities, and you can't print dollars to help your banks when they need them, well, maybe it's good enough if you're holding billions and billions of dollars in your reserves, because then you can lend them to the banks. So many emerging markets have taken this route. And perhaps the most controversial proposition is that, if you can't handle things in a cooperative way with other countries in the rest of the world, then use capital controls, close off your capital account, administrative measures. So this is sort of the range of things countries can do by themselves, and some of them are less controversial than others, capital controls being probably the most controversial, and I'm happy to take questions about that. The other thing that's been incredibly important is the Basel process. There's a book recently came out by Charles Goodhart on the history of this. It's not for the faint-hearted, but it is the definitive history, and it only goes up until like 1997. But 1974, this process began very organically, where central bank technicians got together and saying, if we talk to each other, maybe we can come up with common rules and exchange information in a way that will make our actions more effective. And it's actually been a huge success at some level, and it's gotten more and more recognition and become more and more official. The most recent wave of this is called Basel III, which has a lot of provisions. It's very complex, but it includes minimal levels of bank capital. This has always been a main point of the Basel process. So, a bank has assets, it has liabilities. You can't start a bank without some cushion in case you have a negative shock to your assets. So this cushion is the bank's equity capital. It's the amount that the bank can stand to lose before it becomes insolvent. And Basel III tries not only to enhance bank capital and in quantity and quality, but also to set up what they call counter-cyclical capital buffers. If you ever see domestic credit growing really quickly, as in that picture I showed you, a country can demand that banks supplement their capital. That's this counter-cyclical buffer. Great book I recommend to everyone by Admati and Hellwig on the banker's new clothes, if you want to learn all about bank capital and the issues around it and the politics around it. So Basel III is sort of proceeding, but it's not without critics. And one of the problems with Basel is that it has a very complicated system of risk weighting of assets. Banks are allowed to put aside less capital against assets that they deem are less risky. But the formulas are incredibly complex. So just to give you an idea, this comes right out of the Basel III rule book from the Bank for International Settlements. And this formula describes the bank capital charge against over-the-counter derivatives. Okay, so this is my one equation today. And believe it or not, there's a fierce dispute now going on between the US and the European Union about how to apply this, this formula for derivatives. Now, whenever things get this complex, you know that you're going to have very well-paid analysts who are figuring out how to game the system. And so this is, one of the problems. Now, another very useful innovation, which was created after World War II, is the IMF, with nearly universal membership of 188 countries. And it lends to governments that lose financial market access, but it does so with conditions. Two main problems with the IMF are that its resources are quite limited. It has about less than a quarter of the resources that China has in its international reserves, for example. And also, it's really slow. So the IMF started discussing what to do about Ukraine's finances in the first half of March. And the money just became available like now. And unfortunately, things have deteriorated in Ukraine to such an extent that the IMF is saying, well, actually, if you guys lose half the country, we need to rethink how much we're lending you. And, and so God knows. But this sort of illustrates why the IMF, is kind of not the ideal tool for fighting crises. Another very important innovation is central bank swap facilities, which were institutionalized among 6 big central banks in October. And under these facilities, if the European Central Bank needs dollars to act as a lender of last resort, it gets them from the Fed. If the Swiss National Bank needs euros to act as a lender of last resort, it gets them from the ECB. So this is a major innovation. It doesn't include emerging markets for now, although there are some, such as Korea, which I would imagine could easily qualify in the near future. So just to wrap up, this is progress, but more is needed. If you followed, the IMF was supposed to have a major reform that was agreed back in 2009, and it's been totally blocked by the House of Representatives. We need more harmonization of regulation, including, I believe, higher capital requirements, globally. If we're going to think about capital controls, then it's probably better to have some sort of system of agreements for how they get used, such as the World Trade Organization's safeguards for import controls. We need to work really hard on tax evasion and money laundering. That's a major, major issue. And, as an economic researcher, I always push the idea that we need more data and better funding for research. So that seems to me obvious, but not everyone agrees. How to close down systemically important institutions, something governments are talking about, but even in Europe, that's been a very controversial issue. And the Europeans just agreed on a EU mechanism for that, and that was hard enough. And it illustrates why, their experience illustrates why it's so hard globally to come up with these sorts of agreements. But, ultimately, as I said, there are these two approaches: do it yourself or have international agreements. And my belief is that if we value international integration at an economic and financial level, the cooperative approach is going to be much better at preserving that than allowing countries to retreat behind their own administrative walls. But I fear that if we can't cooperate more, we will get more fragmentation rather than globalization. Okay, so I'll stop there for questions.
Hi. So you mentioned capital controls. I was wondering what you think about ring fencing, the idea that you want to contain the liabilities within a certain country or cover up the liabilities within a certain country, and what are some of the costs of that, or how does that relate to what you talked about?
Okay, well, when you say ring fencing, people think about the Volcker rule. That's not what you're talking about?
I mean specifically within countries.
Right. The topic of capital controls is really complicated because, you can talk about inflow controls, which limit the extent to which countries can borrow from abroad, or you can talk about outflow controls, which prevent people from moving their money out of the country. So I don't know if you're talking about either of those or both of those, or okay. So the evidence, there's two problems with capital controls. One is that we don't know how effective they are, and it seems that, and I can cite a lot of empirical studies that reach different conclusions, but it seems that, it's sort of easier to keep money out than to keep it in, is one thing that seems to be the case. And whatever you do, markets seem to find a way to get around it in various ways. So the evidence on controls is very mixed. It seems that the countries that are most successful are those which have very thorough, very long-standing controls with well-developed administrative apparatuses for keeping them in place. And you're not going to build that overnight. So most of the recent discussion has been, the U.S. has lowered interest rates, we're getting a lot of inflows, let's stop them. That's much, much harder to do. And the other problem with the latter approach is that if I stop them, so I'm Uruguay and I stop them, then they're just going to go to Peru, right? And so from a global level, it's maybe not that perspective, but that effective. So my view is that I know it's become more accepted to talk about using capital controls for short-term management, but the evidence on their effectiveness is very limited. And then, once markets expect capital controls are a regular part of the toolkit, how does that affect stability? We don't know. So my preference is, if there are other tools available which don't involve closing the capital account. So, for example, Korea, one of the actions they took was to restrict banks foreign currency liabilities. But they don't distinguish between residents and non-residents, so they're not capital controls. And that seems to hit the problem that they're trying to get at much more squarely. So
do you think that a Korean approach would be useful in some other countries and other situations?
Well, the Korean approach is kind of what people call macro-prudential. So basically, it's regulation, and again, can you do it effectively? Well, the limited evidence suggests that for Korea it was pretty effective, but again, people in the financial industry are paid to find ways to get around things like this, and so the effectiveness is usually limited.
Question on growing central bank balance sheets, both kind of domestic assets and foreign assets. You mentioned earlier using kind of foreign assets as precautionary savings, but also with the new swap currency in the 2013. So how do you kind of see those two balancing out moving forward, affecting kind of growth?
Well, a lot of emerging markets, acquired a lot of foreign reserves over the 2000s, and part of the motivation was that they were trying to maintain weaker currencies, so they were intervening a lot to buy dollars as a way of keeping the dollar strong and keeping their currencies weak. So these actions certainly affected their balance sheets, although in many cases, if the central bank has a large balance sheet, it's got a lot of assets, a lot of liabilities. Liabilities are money. Central banks try to replace those monetary liabilities with non-monetary liabilities, such as what they call sterilization bonds to soak up the money. So, and that's been a problem for the central banks in the sense that they have to pay interest on those, but they don't get much interest on the dollars. So that's been a cost for them. And I think moreover, accumulating all these reserves has kind of been a cost for the international system in the sense that, the central banks have to manage these reserves, and that management may have interest rate effects in the reserve issuing countries, or exchange rate effects, or who knows. So there are problems. Having swap lines is actually, to my mind, a great alternative because you don't have to hold these reserves. If you need dollars, you're going to go to the Fed and get the dollars. And then you bear the credit risk. And, once you've been paid back by your domestic bank, you pay the Fed back. And, any balance sheet effects are unwound. So that's a really great system. The problem is that it only includes 6 central banks right now, and it doesn't cover the emerging markets at all. So it doesn't reduce their incentives to, accumulate reserves with all the resulting, balance sheet distortions. So.
First off, thanks for coming. My question's kind of lighthearted. It's just so you mentioned that you were hoping for more funding for research or data. And I guess my question is if you could have any data set, or if you had a data genie that gave you 3 wishes, unlimited, whatever data you needed, what would be the most useful for making progress in this area of research and answering some of the questions that you addressed?
Well, I mean, ideally you want to know, every financial asset and liability, including derivatives of every actor in the economy, so that you can trace, who is lending to whom and who is exposed to whom, and that's the kind of stuff you'd like, this very granular information, and then you could sort of trace out, well, if we don't bail out Lehman Brothers, like what's going to happen? And then you would know, oh, well, there's this guy here, AIG, and, if you don't bail out Lehman, they're going to get into big trouble because they've written all these credit default swaps. And that's just the kind of information that we don't have. So under the Dodd-Frank regulation, a new unit within the Treasury was set up, the Office of Financial Research. And one of their remits is to try to improve data collection and think about, what kind of data would you need? Because, obviously you're never going to have all the data. So you need to pick and choose, what would be most useful in that context. And, I think that's one of the most valuable parts of that legislation, because it actually recognized this need for more knowledge and more research on financial stability.
So it looks like most of the solutions on this slide have a lot to do with politics. So I'm wondering what your view is on the role of professional academic economists in pushing these solutions forward.
Well, we can write about it, and we can write op-eds, and we can try to inform research, and I'm not being facetious. I mean, academic research actually does get expressed on the public stage through a number of channels. For example, the IMF is a producer and a consumer of academic research, and they talk to governments, and they, when they make a recommendation, it's in the press. Unfortunately, the power of good ideas compared to the power of vested interests is very limited. And, we know as economists that, like, even when we talk about Pareto improvements, right? The Pareto improvements we talk about are policies that in principle could make everyone better off. And in principle means after you do lump sum redistributions. But in practice, there are winners and losers, and the redistributions never get made. And so, that's why Pareto improvements are very, very unusual because of the politics. So, it's our job as economists to say, like, hey, this would be a huge free lunch for the economy if we could only make these redistributions. So how can we think about policies that would help this happen? So, free trade, we talk about adjustment assistance, and that is actually a serious thing, and that's kind of made it onto the, politicians actually discuss it. It's much harder to get legislatures to pass it. But, I think the analysis that allows one to identify these potential gains is hugely important for just sort of setting the agenda. And then, of course, the politics are going to be very, very difficult. But if the analysis is clear and agreed upon, that helps a lot. So you can say, well, global warming, the politics, carbon tax, the politics are horrible. But I think gradually, we do make progress as people understand the magnitude of the problems and come to accept the analysis. So I think, in the long run, these ideas do tend to gain a lot of currency, but that long run may be very long.
So when you were mentioning interconnectedness, you talked about how a lot of network models are being used in the literature, and I'm assuming that they enjoy some empirical success, or else we wouldn't be using them. But my impression is that to some extent, economists are distrustful of them. Could you elaborate on that?
Are distrustful
of network modeling?
I mean, it's hard to integrate network models with, prices and stuff like that, so economists get very nervous. But I think in terms of the just thinking about interconnections and modeling them, they're really, really an important tool. And, I think our modeling will get better as our tools develop. But, we need some way for thinking about these very complex interrelationships because they are a real policy issue.
We had Sir John Vickers through. So in answer to Nelson's question about political economy, I relay on one thing he said. He says it's really nice that Britain has the ability to knight people because that was part of the package in order to take over this job of central bank reform and convene this independent commission. It was like, well, after this, you'll be Sir John Vickers. Your wife will be Lady Vickers. But
we should have that in this country too.
You see, if there's nothing out there to sort of reward people for taking these huge jobs that require expert opinion and then balancing a whole bunch of different interests, I think there's something to that. I mean, there is really the need for people to step forward who are experts. So, on another front, this also reminds me of Taiwan. So this is to help students along. Taiwan survived the Asian financial crisis in 1997 when everybody went and there was a run on, if people don't know this, there was a run on the Thai baht, right? And so there was this massive capital flight. So prior to that, again, there's been run up on foreign money and there's a big housing boom. But then when they thought, I don't know if we run, well, the upshot is a lot of capital left very quickly. And then there was this idea of contagion. So other investors with money and other Southeast Asians also started pulling their money out. And it got to Taiwan and you couldn't take your money out because the capital controls were there, a long-standing tradition. Right. And the belief there was actually something that had been set up by my father's generation of economists setting up their monetary system. So you really couldn't get your money out. It was in, and you couldn't just exchange things denominated in the local currency for foreign fungible currencies. So there are institutional differences. And that whole system was set up in a day when the idea of international capital flows as this as important as trade sort of globalization was just not really well sold at that point. And so everybody leapt on that bandwagon. Maybe, do you feel that it was before the international regulatory mechanisms were properly in place?
Well, yeah. So, I haven't gone into this whole history, but when the IMF started, which was in 1946, it started operating, it was premised on the idea that countries would keep capital controls. They had them from World War II, they would keep them, and it was not a priority to dismantle them. Quite on the contrary, there were rules against funding capital flight with fund resources. But then gradually, once we moved to floating exchange rates, you didn't need to, control the capital account as strictly in order to maintain an exchange rate peg. And that's where, Taiwan's came from that era. So countries began to liberalize. And as I said, there are gains from liberalization. There are definite gains, but there are also dangers. So, the political process has to determine where you want to be. And, most countries have been moving in the direction of liberalizing and allowing their exchange rates to be more flexible, but then holding more reserves as safeguards since the Asian crisis of the late 1990s, including Taiwan. So, but now the pendulum is swinging back a little bit with people saying, well, maybe those controls were not so bad in some circumstances, but again, we don't know if, sort of opportunistic controls are going to be hugely effective. We have very little evidence. In fact, one recent paper says that the only thing that is really effective in terms of affecting the capital account is when countries loosen existing controls on outflows. That seems to be effective. So we don't really know. the point you made about compensation is, I think, a really important point. And it's like, very important for an audience like this. Because so one of the things about the US in particular, but also other foreign countries, is that, if you work on finance in the Treasury or the Fed, or even the International Monetary Fund, where people are paid much better, you're gonna earn very little, right? You sort of look at what you should look sometime at what the chairman of the Fed makes, okay? Because you're not going to make that much, and it's not much by the standards of hedge funds and whatever. And so how are these regulators who are so poorly compensated supposed to keep ahead of the people in the private sector who are getting paid orders of magnitude more than they are? I mean, it really takes a lot of dedication to public service and to the public good. And I don't know how to really, how one really addresses that problem, but I think it's a major structural problem that the talent that is trying to evade the regulations is so much more highly paid than the talent that is trying to write the regulations. And we just have to rely on people to, who are public spirited to go into public service. So the first head of the office, I mentioned the Office of Financial Research at the Treasury. The first head was Dick Berner, who had been the chief economist at Morgan Stanley, and he retired to go run the Office of Financial Research. So here's someone who had been, getting the big bucks on Wall Street, and he said, well, this is really important, I'm just going to go do it. So, we may just have to rely on the public spiritedness of, people who can actually help.
Same with people who went to the CIA post 9/11 from Wall Street to track terrorist financing.
Right.
Effective.
Absolutely. Yeah, absolutely.
Okay, well, thanks very much.
Thank you.